Greetings and welcome to this week's edition of Smart Counsel for Lunch. I'm Suzanne Sayward, a partner at the Dedham, Massachusetts law firm of Samuel, Sayward, and Baylor, where we concentrate our practice in the areas of estate planning, elder law, estate and trust administration, and probate. Well, on a quarterly basis, we present what we call the Smart Counsel interview. One of our attorneys will interview a person who's in a profession or business that we think would be of interest to our viewers. You can see some of these interviews on our website or by going to our YouTube channel. For this quarter's interview, I've chosen Steve Pepe. Welcome, Steve, and thank you
Thank
for
you.
being here, who
Thank you for
focuses
inviting
his
me.
business in the area of reverse mortgages, which is a question we get a lot from people. I've known Steve for many years via our association and membership in the Massachusetts chapter of the National Academy of Elder Law Attorneys. Steve is an attorney, even though he does not private practice such as we do. So let me tell you a little bit about Steve. Steve is a reverse mortgage consultant with Longbridge Financial LLC. He earned his JD from Suffolk University Law School in 1998, and in 2006, Steve pivoted his career to originating reverse mortgages, where he leverages his legal skills to distinguish himself as a top producing loan officer and industry expert. And I can vouch for that because I've seen Steve present on this topic on a number of different professional programs. Steve is a former reverse mortgage counselor and an active member of the National Academy of Elder Law Attorneys and various other bar associations. Steve is a frequent contributor in print and radio and a CLE lecturer on the topic of reverse mortgages. He lives in Milford, Massachusetts with his wife Kerry and has been an avid drummer since age 8, something I did not know anything about. So again, Steve, thank you, and we appreciate you being here, and welcome to the Smart Counsel interview.
Thank you,
So
Suzanne. Thank you.
you're quite welcome. And you want to tell us a little bit about your company's protocols and what we can expect from you today in terms of what you are sharing with us.
Sure. I just have a few statements I need to make just to keep everything compliant from a regulatory standpoint. Like you said, my name's Steve Pepe, and I'm a reverse mortgage consultant at Longbridge Financial LLC. My NMLS ID number is 485943, and I'm licensed to lend reverse mortgages in Massachusetts, New Hampshire, Rhode Island, and Virginia. This is an educational effort today. Longbridge Financial and Samuel, Sayward, and Baylor are not affiliated, and nothing in this presentation is an endorsement by any party for any of their services, products, or service providers. So, prospective customers are encouraged to shop around. Other than that, let's get to it. Let's get to
All
the heart of
right.
the matter.
Thanks for the legalese, Steve. We always enjoy that. So I think I'm just going to start off by saying, please give us an overview of what is a reverse mortgage.
Sure. So a reverse mortgage is a tool that a homeowner who's age eligible can use to release some of the equity they have tied up in the four walls of their home. So Americans age 62 and older entered 2025 with over $14 trillion of
Mm.
home equity. That's a staggering amount. But it's wealth, but it's not liquid wealth. So a reverse mortgage is a type of loan that enables homeowners that are age eligible to monetize or release some of that home equity to spend on anything that life throws at them, any expense life throws at them. And unlike other mortgages out there, with a reverse mortgage, there's no required monthly or periodic payment that the homeowner needs to make back to the lender, as long as that homeowner keeps up with paying their real estate taxes, their homeowner's insurance, their condo fees, and they keep their home in good condition, then they do not have to repay any of the money they borrowed or accrued interest and costs until they no longer live in that home, until what we call a maturity event occurs. And a maturity event would be if they pass away, if they sell their home, or if they move out for more than 12 consecutive months because of a health condition. Those are the main maturity events. And the things we don't like to talk about is if someone is in default because they didn't pay their taxes or their insurance or keep their home in good repair. So that in
So,
essence is what these loans are.
and they could use the loan proceeds to pay the taxes and the insurance and keep the house in good repair, right?
Absolutely. Those are very common uses for these funds. In fact, you can even set one of these loans up and ask your lender, I would like you to automatically take money from my reverse mortgage and pay my taxes and my homeowner's insurance on my behalf for the rest of my life expectancy. And we're happy to do that because what does that mean? It means you're not going to forget one of those things and potentially find yourself into fault.
So does the loan work as like a lump sum? Say I get a reverse mortgage for $200,000. Do I get a check for 200,000 or is it like some home equity lines where they send you a checkbook and you just draw money as you need it?
So, what I'm going to explain now is a government insured reverse mortgage that's been out since the Reagan administration. It's the most popular one that's out there. And under this program, if you want a fixed interest rate, then the only option for receiving the funds is one lump sum after your loan closes and your 3-day rescission period expires. So, in that case of a fixed rate government insured reverse mortgage, you're going to get it all at once. More often, people are choosing adjustable rate versions of the same government insured program. And the government insured variable rate programs have much more variety in terms of how to receive the funds. You can set it up as a line of credit and withdraw funds as needed. That's what about 7 out of 10 people choose.
Hmm.
You can choose to have the reverse mortgage send you a monthly disbursement of money every month, either for the rest of your life while you're living in that home and paying taxes, insurance, and upkeep and condo dues, or a monthly payment for a term certain, and then it stops at some point, or a combination of a line of credit and a monthly payment, or a line of credit and a small lump sum to do something like pay off those pesky credit cards that are charging 25% interest. Right?
Makes sense. Makes
Mhm.
sense. Um, so tell us a little bit about the process and the eligibility. You mentioned that you have to be over 62. Beyond that, do you have to have a certain amount of assets or not have a certain amount of assets, or is there an income threshold? How does that all work?
Sure. So for the government insured program, which by the way is called the Home Equity Conversion Mortgage, we call them HECMs, HECM. You have to be at least 62 years old. At least one owner has to be 62. Okay. You have to either own the home outright in what we call a fee simple ownership or a joint type of ownership with another person, or have a life estate interest in the property, or have a beneficial interest in a trust that owns your property. And then there's other trust requirements that we won't get into today. You have to live there as your primary residence. So you can't use this on a vacation home, a second home. Okay. Has to be a single family home,
Mm.
certain condominiums, an owner occupied 2 to 4 family home, or a mobile home, which they call a manufactured home that is permanently affixed to the ground, like on a concrete slab, and then some certain other requirements with mobile homes we won't get into with our limited time here. In terms of income and creditworthiness, it's not nearly as stringent as applying for a regular, say, 30-year fixed rate mortgage
Mm,
or even a HELOC, where there's a lot of scrutiny with income and credit history. But yes, we are looking at income and credit history from a standpoint of what has been your track record at paying your taxes, homeowners insurance, and condo dues for the last 2 years before you applied for the loan? And if this reverse mortgage money was all used up, do you have the ability through your income and your assets to pay your future taxes, insurance, and condo fees if all this money was gone?
mm,
We want the answer to be yes, and we want to see you have a good track record of paying those things in the past. If you don't have a good track record paying those things in the past, or paying your other major bills like your mortgage bill or your credit cards or your auto loan, doesn't necessarily mean you are going to be denied. But what it might mean is that we, the lender, might then compel you that if you are going to get a reverse mortgage, we have to pay your taxes in your homeowner's insurance going forward. It's no longer a choice of yours. We
mm.
must do it because we're a little nervous about your ability to pay those things in the future. Okay. So there is a review of of income and creditworthiness, not to the extent of other kinds of mortgages. It's all meant to make sure, hey, there's a high probability you're not going to default on this loan.
So, in a regular mortgage, there are fees and costs associated with it, right? Like you might have to pay an origination fee, and there's recording fees, and sometimes there's a tax escrow or something. How does that work with a reverse mortgage?
Sure. So with a reverse mortgage, there are closing costs or initial fees in order to make one of these loans a reality. And these fees can vary, some of them can vary by state, uh, but these closing costs come in three categories. Okay. Category one for the HECM program, the government insured program, is a government mortgage insurance premium payable to this government mortgage insurance fund in Washington. And that is going to be equal to 2% of the value of your home. So if you're in a $500,000 home, that's a $10,000 insurance premium. If you're in $1 million home, that's a $20,000 insurance premium. It gets capped at a certain point, but you can talk to someone in the industry about what that cap is. But that's one category of closing costs. Second category is an origination fee. HUD, our regulator, sets a floor of $2,500, sets a ceiling of $6,000, and your origination fee could be anywhere in between that floor and that ceiling. It will depend on how much your home is worth, and it will depend on what lender you're speaking with. And there's formulas for determining that origination fee, but that's the range in the industry, typically 2,500 to the $6,000 cap. And then there's that catch-all third party fee category that anyone who's gotten a mortgage in the last 20 years, anyone who bought or sold a home in the last 20 years is going to be familiar with these fees, appraiser, attorney, recording fees, title insurance, flood zone check, credit report, doc prep fee. Those fees are going to vary somewhat to some extent on how much your home is worth, but they're going to be, a few thousand to, pushing on very valuable homes, potentially 6 or 7 thousand if you live in the Commonwealth of Massachusetts. If you live in other states, those states might have additional taxes that they lump in to mortgage transactions, and those fees could be a lot higher. So you need to
Mm,
talk to someone licensed in your state to know what are those party fees in your state. Now, the majority of these fees, the categories again, government insurance, origination fee, third party fees. Most of them are financed, meaning they're rolled into the
Mm,
loan. We're using the loan to pay them. So before you worry, how am I going to write a check that big to a lender? I'm doing this so I can get more money. You don't have to worry because most of them are rolled into the loan. It means you're using borrowed money to pay them, so that is part of your beginning loan balance and part of what interest accrues on from day one. There will be a couple of those fees that you will have to pay out of pocket. Okay. Those would be a fee to a reverse mortgage counseling agency. That might be $150 to $200 range. And then sometimes a lender can request a deposit for the appraisal or maybe the full cost of the appraisal upfront. And so those might be a person's only out-of-pocket fees. The majority of them are financed. Okay.
that's very helpful. And are the interest rates on reverse mortgages comparable to interest rates on, say, a 30-year fixed mortgage or a variable rate mortgage that somebody might obtain on their home?
Right now, we're filming this at the end of May 2025. They're comparable to those rates, probably within a percentage point. They're comparable to what you'd see there. Um, the big differentiator is that those rates on those other kinds of mortgages are usually tied to the prime rate, the federal funds rate that the Federal Reserve Board manipulates when they make monetary policy. In the reverse mortgage industry, no matter what state you live in, no matter what lender you're speaking to, this government insured reverse mortgage is tied to the yield on the 1 year US Treasury bill. So
Mm.
it's going to be that 1 year Treasury bill plus a lender's margin. And so right now, those 1 year Treasury bills are in the low to mid fours, and who knows what's going to happen. That's not the interest rate on a reverse mortgage.
Right.
That's the 1 year Treasury bill rate. And interest rate's going to be something higher than that because you've got to stack the lender's margin on top of that. But they're fairly comparable to what you're seeing in the regular mortgage market.
Good, good. So one thing I wanted to go back to is you mentioned about that maturity date, when the loan has to be paid, someone passes away, or someone, say, needs to move out and go to a nursing home. What happens when there's a spouse? So you have a married couple living in the home. One of them doesn't qualify for the reverse mortgage, like the wife is only 60 and the husband's 62. So how does that whole scenario work?
Sure. So since August of 2014, there have been some additional consumer protections put in place at the federal level that are going to help couples like that um, in certain circumstances, where couples like that, meaning spouses, so they have to be married, okay? And one is qualified for a reverse mortgage and is the borrower, and one is not qualified for the reverse mortgage for whatever reason and is not a borrower. Okay, so first let's talk about a death, and then let's talk about the nursing home scenario. These protections come into play when there's a death. So let's say, typically, I'm going to generalize, but let's say we have a heterosexual couple, man and a woman, and the man, the husband, is the qualified borrower. They're typically older, right? A lot of times, the clients that we see. They're the reverse mortgage borrower, and the wife is not because she's younger or because she's not named on the title or something like that. They get a husband gets a reverse mortgage. The lender is going to take certain steps to identify the wife as what's called an eligible non-borrowing spouse. And there's very significant protections in play when we have the wife or the other spouse labeled an eligible non-borrowing spouse. It means that spouse lives there, as their primary residence. They're married to the customer, the borrower, but they're not a borrower on the loan. As long as that couple stays married, taxes, insurance, condo fees remain paid on time. If time marches on and then the borrower spouse, a lot of times the husband, dies first, the wife can remain in the home, not have to repay the reverse mortgage for as long as she lives there. That's a tremendous protection
Hmm.
that was not in place prior to 2014. That spouse, that surviving spouse, cannot take out any money from the reverse mortgage because they were not a borrower.
Mm.
But they don't have to pay it back as long as you're going to be sick of me saying this. They pay taxes, insurance, condo fees, keep the home in good condition. Repayment is deferred. This protection only comes into play when there's the death of the borrower's spouse. If we have the same couple, but then the borrower spouse, let's say the husband, gets ill and then has to move into a nursing home, or gets injured and has to move to a nursing home or an assisted living facility, the moment that spouse is absent for more than 12 consecutive months, unfortunately, the loan is called due and payable. And
Mm.
then the loan has to be repaid within a certain grace period. There is no non-borrowing spouse protection in play in a scenario like that. So it may be that the spouse has to sell. It may be he or she is then age eligible to get their own reverse
Hmm.
mortgage and pay
Right?
off the first one, or go to XYZ Bank and get their own HELOC or 30-year fixed rate mortgage and get rid of the reverse mortgage or something like that. Okay.
But they have 12 months to figure that out.
Yes. So if the path of the sick or injured spouse is hospitalization from something terrible, rehab in a nursing home, and then back home with support, and that's a 6 month journey, you didn't rock the boat. There's no
Hmm.
disruption to anything. The reverse mortgage has kept on chugging along, no disruption. But it's got to be a year and a day out of the home to be a
Okay.
maturity event.
And now how do they figure that? I mean, how do they pay attention to that? How do they check on that? How do they know, when it's a year and a day?
That's realistically a really good question. I mean, a lender, every lender servicer is going to send at least once a year an annual occupancy certification that the borrower has to sign and send back within a certain period of time saying, yes, I still live in the home. I swear that I still live in the home as my
Hmm.
primary residence. So if the answer is no to that questionnaire, that's one thing. A lot of times, realistically, I don't know that the lender is going to know the exact day that someone has left. You can't lie to your lender. If the lender asks, you have to be truthful. But it logistically and realistically might be something that is hard for a lender to keep track of. If a lender starts getting mail bounced back, if it's
Mm.
undeliverable, if they're going to say what's up, if a lender, the lender always has an option to, a borrower always gives a lender at the time of application permission to look at tax return transcripts on a go forward basis. If for some reason in an audit or something like that, an audit of the lender pulls a tax return transcript and there's a different address.
Hmm.
That might be a different way, but it might be difficult, honestly, for a lender to know.
Gotcha. Gotcha. That makes sense. Um, let's see. I know we don't have too much time left, but a couple of things that I think our viewers would want to know is you had mentioned before the type of home ownership, owning it jointly or in your own name or in certain types of trusts. And is a life estate okay? Some people have what they call a life estate on a deed, where,
Yes.
say, parent conveys the house to the child and keeps the life estate. So the parent could, eligible parent could borrow on that. And how much, so say somebody has a house that's worth 600,000, how much of that can they borrow on a reverse mortgage?
Sure. So someone with a life estate can get a reverse mortgage, but it will take the cooperation of the other people named on the deed that we call the
Gotcha.
remaindermen, remainder people. They have to go along with it and complete certain steps and sign certain documents. So if you have a family who's dead set against it or can't stand one another, then that holder of the life estate can run into some issues. So
Gotcha.
whether a person has a life estate or a person has a joint ownership or a total 100% ownership or something like that, none of that impacts how much they can borrow. How much anyone can borrow is dependent on three things, and the federal government controls this formula. So, what lenders plug into this formula is we plug in the age of the youngest borrower, the estimated value of the property, and the interest rate on the day that we're running the calculation or the date the person's applying. Those three things are what determine how much any person can borrow. And
Mm,
two rules of thumb to keep in mind: the older a person is, the larger that percentage is going to be. So an 80-year-old can borrow a bigger percentage of their home value than a 70-year-old living in exactly the same home on the same day. Okay. And also, the lower the interest rate, the more money a person can borrow. The higher the interest rate, the less money a person can borrow. So, with the rest of the mortgage industry, the impact of this high interest rate environment we're in now, spring of 2025, is that those companies, their borrowers have to pay bigger monthly mortgage payments because those interest rates are higher,
mm,
right? With the reverse mortgage industry, the impact is that high interest rates mean we can't lend out as much money. Okay. Because again, you don't have a required monthly payment you're making to a lender. It
right.
means the loans we can make are smaller today than they were in 2020, when interest rates were half of what they are in 2025.
Right. Right. Good. Okay. So final question or point is, who would you say, Steve, is the ideal candidate for a reverse mortgage?
Sure. So anyone who's age eligible and owns a home and has either had an increase in expenses or a decrease in income brought on by a number of different reasons, an illness, a spouse, loss of a job, increase in credit cards, increase in interest rates on other types of mortgage debt and things like that. And they're just experiencing a cash flow crunch, right? That has always been the traditional use of these products, is to help alleviate that cash flow crunch that comes up month after month, year after year, because of other kinds of consumer debt or a drop in income or increase in medical bills, house repairs, those kinds of things.
Hmm.
Anyone who's age eligible and needs some home renovations, home repairs, wants to put an accessory dwelling unit on their home. That's all the rage right now.
Right.
Someone who wants to make accessibility modifications to their home to make sure it's their forever home if their health declines.
Mm.
Ramps, grab bars, elevators, stair lifts, that kind of thing. Okay. Anyone who has a mortgage or a HELOC and wants to get out of what I call the traditional bank HELOC trap of you set up one of these kinds of mortgages and you have a small monthly payment at first, but then it gets two times larger, three times larger, and uh-oh, now I can't afford my payment anymore.
Mm.
Anyone who's 62 and older and wants to relocate and buy a new principal residence, you can use reverse mortgage
Oh.
financing to do that to buy a new residence. And it's really neat when you see it used that way. Don't have time today to discuss it,
Yeah.
but it's a great use of it. And then finally, even people who might be more affluent, people who have a lot of savings and investments, but they want to protect those savings and investments and have those other investments they've worked so hard for to last as long as possible so they don't outlive their money. Bringing home equity into the total picture of their financial plan can help their other things, their IRAs, their 401ks, and other investments last longer. And there's a whole separate planning conversation for those kinds of ways to use the product. So that's who we're looking to speak to, and that's who the industry helps. So
That is really helpful, Steve. I'm going to share your slide information um, on the screen for a minute while we wrap up here uh, and talk a little bit about how would people find you and what states could you help someone have get a reverse mortgage in if they're like if I have a client, I only practice in Massachusetts. So somebody calls me and says, "Oh, my mom's in Rhode Island and she, really needs estate planning." I can't help them. But it sounds like you could help people who have property, primary residence in states other than Massachusetts.
sure. So I am licensed to originate reverse mortgages in Massachusetts, Rhode Island, New Hampshire, and Virginia. Longbridge Financial is licensed in all 50 states.
Okay.
But I can only talk rates and terms with residents of Massachusetts, Rhode Island, New Hampshire, and Virginia. I can't give out my specific contact information on this video, but I encourage people to just, I suppose, Google me and, there's ways on the internet to be able to find me and hopefully we can connect or,
You can
people
always
are
reach out to us, reach out to our
sure.
office, and we would be happy to connect you with Steve. So, Steve, thank you so much. This was really helpful and interesting for me, somebody who knows a little bit about reverse mortgages, but I learned a lot. And I know this is going to be really helpful to a lot of our viewers who do ask us questions quite a bit about what's a reverse mortgage and want to know more about it. So, to everybody out there today who's watching, as always, thanks for watching. We very much appreciate it. Feel free to let your friends and neighbors and relatives know about our videos and about this Smart Counsel interview. And don't forget to like our video and subscribe to our channel before you head out today. And we'll see you for our regularly scheduled program here next week.